We're going to talk about Chapter 7, which is investments. First, we're going to talk about portfolio versus passive investments. So portfolio investments are investments that produce dividend, interest, royalty, annuity, or capital gain income. These are standard types of investments that most people have, and they may be taxed at ordinary or preferred rates. Some of the investment income is taxed annually, but for capital gains, the income tax is deferred and you're taxed on that when it is sold. Losses are deferred until sold, and their deductibility is subject to limitations, which we'll talk more about in a little bit. For passive investments, they generate operating income and operating losses, but the ability to deduct losses is limited. These are more owned by wealthy individuals, and they're taxed as ordinary income, and losses are deducted against ordinary income. The taxpayer doesn't actually participate in these activities, and it's important to note that you can only deduct losses to the extent that there is passive income. Then we talk about portfolio investments. So portfolio investments can be things like U.S. Treasury bonds. Those are exempt from state income taxes but not federal, and they pay interest periodically and are considered one of the safest investments in the world. Dividends that are either qualified or non-qualified. Qualified dividends are taxed at a preferential rate, the capital gains rates, while non-qualified dividends are taxed at ordinary rates. Most people own qualified, but if you own a mutual fund, you will likely have non-qualified too. Requirements for it to be a qualified dividend: first, it has to be a domestic or qualified foreign corporation, and the taxpayer has to own the stock for more than 60 days during the 121-day period centered on the ex-dividend date. There's a good illustration in your textbook of what that means. All right, another type would be capital gains and losses. So we've talked about this quite a bit so far, but capital assets are the investment type assets and personal use assets like stocks, collectibles, business assets, home, or car. The advantages of investing in capital assets are, first, the gains are deferred. Oh, I need to check my spelling here. Deferred until you sell the asset. The second one is that the gains are taxed at preferential rates. So we have our capital gains tax rate schedule that you're already familiar with. The capital loss deductions are subject to limitation. You guys are already comfortable, I think, with the calculation of gain or loss, which is amount realized minus adjusted basis. And we go into some detail in this chapter talking about if we have groups of stock, what are we doing, which one are we selling? And if you use the FIFO method, you may not get the best tax result, but it's kind of the quickest and easiest if you don't care. Specific identification: if you know the specific stock you're selling, you can have more control over what the gain would be or the loss for that. Again, star number 5, losses on personal use assets are not deductible. So there's a lot of information on the next couple of pages, and I'm going to go through it pretty quickly so that we can get to the examples. I feel like if we solve a few examples, we don't have to necessarily go through and memorize this process step by step. So first, we want to think about types of capital gains and losses, and we have short term, which are assets that are held for 1 year or less, so 1 year or less, and they're taxed at ordinary income rates. Long-term capital assets are the assets that qualify for preferential rates, and they need to be held for more than 1 year. And we know the preferential rate is according to the capital gain and loss tax bracket schedule. You guys are now comfortable with 1231 gains. We know that there's a category for 1250 unrecaptured, and we know that there's a 1231 netting process that we will go through and complete here as well. We also have a special category of capital gains for collectibles, and these are taxed at a higher 28%. And then there's one final category, which is qualified small business stock. Sometimes this is called Section 1202 stock, and it's also taxed similarly to the collectibles at 28%. So the netting process for short-term and long-term capital gains occurs when the taxpayer sells multiple capital assets during the year. So this is what I didn't want to go through in a lot of detail because I want to work through the examples. And then as we're working through the examples, you can come back and look at these steps. So situation 1 is when the taxpayer doesn't have any long-term capital gains at the 25 or 28% category. So it goes through the steps there, and I'm going to skip to the example. So first, we are going to assume we sell the following stock during the year with these results. We have an $8,000 short-term capital gain, a $9,000 short-term capital loss, a $4,000 long-term capital loss, and a $10,000 long-term capital gain. What is our tax liability on the sale of these assets? So we want to put the short together and then the long together. So we have short, which is an $8,000 gain and a $9,000 loss. And then for the long, we had a $4,000 long-term capital loss and a $10,000 long-term capital gain. So you put the short with the short and the long with the long, and you end up with a $1,000 short-term capital loss and a $6,000 long-term capital gain. We then net those together, and we end up with a $5,000 net long-term capital gain, which we know is going to be taxed at a preferred rate. The problem tells us it's 15%, so the tax rate on the capital asset disposition that we've read about here is $750. Next, we're going to assume we sell the following stocks with these results: $4,000 short-term capital gain, $7,000 short-term capital loss, $5,000 long-term capital loss, $4,000 long-term capital gain. Again, we put the short with the short and the long with the long. We have a $4,000 short-term capital gain, a $7,000 short-term capital loss. For the longs, we have a $5,000 long-term capital loss and a $4,000 long-term capital gain. We net those together. We end up with a long-term capital loss of $1,000, a short-term capital loss of $3,000. What do? You can only deduct $3,000 against ordinary income. So the $3,000 that you deduct would be the short-term capital loss, and you would carry forward the $1,000 long-term capital loss to offset in future periods. Sometimes this problem will ask us how much will we save or how much tax do we pay. So that's kind of what it's asking here. And we can figure out that that $3,000 deduction times our 40% tax rate saves us $1,200 in taxes saved. All right, now we assume we sell the following stocks in year 1. We have a $3,000 short-term capital loss, $5,000 long-term capital loss. The next year, you sell the following assets: $5,000 short-term capital gain, $5,000 long-term capital gain. And the question is, how much tax do you pay on the sale of these assets in year 1 and year 2, assuming your marginal tax rate is 40% in both years? So let's do year 1 first. We have the shorts and the longs. And in year 1, we have the $3,000 short-term capital loss and the $5,000 long-term capital loss. We deduct the $3,000 that's allowed against ordinary income. And that saves us the $1,200 in taxes, similarly to what we just saw above. the 5,000 long-term capital loss carries forward. Then we have year 2. We have the short and we have the long. So we had a short-term capital gain of 5,000, a long-term capital gain of 5,000. We offset that long-term capital loss that we've brought forward. That gives us nothing in the long section. And then we have our short-term capital gain of 5,000. That short-term capital gain is taxed at 40%. I'm sorry, at 40%. And that's 2,000 in taxes owed.